So there's definitely what Morgan Stanley is saying is that there's definitely an overhang in the banking and financial services space. When we look at the numbers, they look quite evident. There was a bit of a rebound in January, followed by a blip in February and March in terms of absolute performance of the banking sector in terms of their returns. Now, what is affecting the banking sector at the moment? Well, one is definitely a weaker economic recovery, and that is largely due to the geopolitical situation, oil, CPI, as well as the current account deficit. The other thing is also that in the budget, there was fiscal consolidation, or rather the announcement was that fiscal consolidation will be slower than earlier anticipated. Of course, the RBI's dovish stance hasn't helped banks because that means that there will be a delay in the interest rate cycle kicking in. And growth also with regard to capacity utilization still below that 75% mark, which means that capacity utilization and capex cycle won't kick in. So why is Morgan Stanley bullish on banks at the moment? Well, they do expect the RBI to start policy normalization in the month of June, which will mean that rates will start to increase, which will benefit banks, of course. And the second thing is that credit growth is expected to accelerate. Of course, there's always a lag between credit growth and economic growth. So at the moment, what Morgan Stanley sees is economic growth kicking in and credit growth to come back as well. Healthier corporate balance sheets means that corporates will be able to borrow better, as well as credit costs having peaked for banks. Bad loans have been provided for, and new provision formation has been slow over the last quarter or so. So a combination of good factors working well for banks, which will translate to better earnings. All of these things will translate to better earnings for banks, with Morgan Stanley believing that a 20 to 30% earnings compounding in banks is on the anvil. When we look at what risks continue to persist, well, slower growth is definitely a risk. Disruptive tightening by the Fed will also be a risk. And the larger risk, again, elaborating on that growth risk, is the macro stability. We have seen geopolitical risk play out, and that will continue to impact banking sector even going forward. When we look at what are the top picks, or rather what are the other things to stay away from, is one is weaker franchises, is what Morgan Stanley is saying, and second is banks with poor return ratios. The top picks for Morgan Stanley in this space is ICICI Bank. They are overweight on that. Strong PPOP growth driving that. The inflection point Axis Bank is reaching with regard to its PPOP growth, and SBI, which they believe loan growth is going to drive SBI forward.